Today, in episode 5 of the Kyle Talks Money podcast, we're going to talk about understanding stock splits and are they good for investors? So hit that like and follow me on YouTube and Instagram for personal finance guidance and wisdom from all over the web. A stock split happens when a company decides to exchange more shares at a lower price for stockholders' existing shares. Because the new price of the shares correlates to the new number of shares, the value of the shareholders' stocks doesn't change, and neither does the company's market capitalization. Companies carry out a stock split for the purpose of lowering the individual share price. A lower share price can make the stock more attractive to a broad range of investors, not all of whom could afford a stock price at, say, $1,000. So what are the types of stock splits? The most common types of stock splits are traditional stock splits, such as 2-for-1 or 3-for-1 and 3-for-2. In a 2-for-1 stock split, a shareholder receives 2 shares after the split for every share they owned prior to the split. In a 3-for-1 split, they receive 3 shares for every share, and in a 3-for-2, they receive 3 shares for every 2. Note, if a company's stock price has gotten very large, many more shares could be exchanged after the split for everyone prior to the split. For example, Apple carried out a 7-for-1 stock split in June 2014. Its per share price was about $650, and after the split, it was about $93 per share. On July 30th, 2020, Apple announced a 4-for-1 stock split, the 5th stock split in company history. Now, a 2-for-1 stock splits. Let's say publicly traded company XYZ announces a 2-for-1 stock split. Prior to the split, you own 100 shares priced at $80 each, for a total value of $8,000. After the split, your total investment value remains the same at $8,000 because the price of the stock is marked down by the divisor of the split. So an $80 stock becomes a $40 stock after the 2-for-1 split. Post-split, you now own 200 shares priced at $40 each, so the total investment is still worth the same $8,000. Now, what are other reasons for a stock split? Besides making the stock price more attractive to individual investors and so potentially expanding the shareholder base, there are a few more reasons a company might split its stock. First, it improves liquidity. If a stock's price rises into hundreds of dollars per share, it tends to reduce the stock's trading volume. Increasing the number of outstanding shares at a lower per share price aids liquidity. Next, it makes portfolio rebalancing simpler. Portfolio managers find it easier to sell shares to buy new ones when each share price is lower because each trade involves a smaller percentage of the portfolio. Another reason why it makes selling put options cheaper. Selling a put option can be very expensive for stock trading at a higher price. You may know that a put option gives the buyer the right to sell 100 shares of stock, referred to as a lot, at an agreed upon price. The seller of the put must be prepared to purchase that stock lot. If a stock is trading at $1,000 a share, the put seller has to have $100,000 in cash on hand to fulfill their obligation. If a stock is trading at $20 a share, they have to have a more reasonable $2,000. Now, this tends to increase share prices. Perhaps the most compelling reason for a company to split its stock is that it tends to boost share prices. A NASDAQ study that analyzed stock splits by large cap companies from 2012 to 2018 found that simply announcing a stock split increased that share price by an average of 2.5%. In addition, a stock that has been split outperformed the market by an average of 4.8% over 1 year. In addition, research by David Ickenberry, a professor of finance at the University of Colorado's Leeds School of Business, indicated price performance of stocks that had split outperformed the market by an average of 8% over 1 year and by an average of 12% over 3 years. Ickenberry's papers were published in 1996 and 2003, and each analyzed the performance of more than 1,000 stocks. An analysis by Takian Luing of the City University of Hong Kong and Oliver M. Rui of China Europe International Business School and Stephen Shui Wang of Renmin University of China looked at companies listed in Hong Kong and also found price appreciation post-split. So then what are reverse splits? Splits in which you get more shares than you previously had but at a lower per share price are sometimes called forward splits. Their opposite, when you get fewer shares than you previously had at a higher per share price, are called reverse splits. A company typically executes a reverse split when its per share price is in danger of going so low that the stock will be delisted, meaning it would no longer be able to trade on an exchange. A good example of a reverse stock split is the United States Oil Fund ETF, USO. In April 2020, it had a reverse stock split of 1 for 8. Its per share price before the split was about $2 or $3. In the week following the reverse split, it was about $18-20 per share. So investors who had, say, $40 invested in 16 shares of USO at about $2.50 each ended up with just 2 shares valued at about $20 each after the reverse splits. Now, here's a word of warning. It might be wise to avoid a stock that has declared or recently undergone a reverse split unless you have reason to believe the company has a viable plan for turning itself around. The bottom line here is stock splits happen, and so it's very important for investors to understand what it means for their investments. While forward splits and reverse splits both have no impact on the total amount an investor has invested in the stock or fund, the former is considered a positive and growth move by the company, while the latter is to help prevent the stock from being delisted on the exchange. Keep an eye on announcements from the companies you're investing in to be better aware of when a stock split may occur. This episode has been brought to you by Smart Money Parenting. I created Smart Money Parenting as a way to teach parents how to educate their kids about money. By starting at an early age using incentives, habits, and money, your kids will grow up to become financially literate adults. We learn almost everything in school, but the one thing most people don't learn is simple budgeting, saving, and even investing. We're brought into a world that revolves around money, yet our kids lack the knowledge and preparation to take on that world. Let's change that. Smart Money Parenting is a course, but also an investment in your kids' future. There are details to the course in the description along with a 20% off discounts code you can use when enrolling. Give your kids the future they deserve.